exactly is the cash value in a life insurance policy, and how can you use it properly?
Just start saving. We're going to change your world.
What's up, folks? My name is Dallas. I am a financial professional helping small businesses and individuals with their retirement planning and overall financial picture for their future. Today, I want to talk about cash value in life insurance and what it really means and how you can leverage it or use it without wrecking the policy. I feel very obligated to make this type of video, and though virtually no one will see this because I'm at the very beginning stages of my YouTube channel, but I really feel desired to make this. There's a lot of information out there, a lot of sales guys, a lot of sales teams that are just cranking and burning IUL policies, index universal life insurance policies. They're just selling it, and I fear that they're not maybe structured properly, and they will ultimately fail, creating even more of a bad name for life insurance. There's a lot of people out there, Dave Ramsey's one of them, that hates whole life, that hates permanent insurance, with good reason. There is an industry built around life insurance, and a lot of people make a lot of money selling life insurance. There's a reason there's a lot of people trying to do it, and there's a reason everyone's trying to shove it down your throat. That all being said, insurance can surely be an amazing tool when structured properly and when it is designed to fit what exactly you're trying to do. And when it comes to the flexibility, the Index Universal Life currently is probably the most flexible type of insurance product that allows you to increase, decrease the amount of insurance, be more fluid with what you're contributing above or below what your intention was in the beginning. There's a lot of flexibility to it. And of course, you have that upside potential with the markets. And in theory, when the market goes down, you have a guarantee no loss. There's still some costs for the insurance portion, which helps to have the actual insurance in place. But there would be a guarantee no loss if the market goes down. That's one of the major attractions to the IUL. However, insurance agents are paid. We are paid based on the amount of insurance. And if that insurance is really high and there's no cash value on that illustration within the first 5 years, then it's paying the agent a lot more commission to do that type of plan for you than it is you potentially in the end. And like I said, it really just comes down to how the plan's structured, what your goals are, what you're trying to accomplish. Sometimes, you can only do $100 a month, but in a couple of years you could do 500. Maybe take that 100 and put it into a savings, or maybe get a term policy right now. That way you can qualify for the insurance, and you want to do the IUL. That way you can just convert it down the road when you can actually do the 500 a month to really do the plan how you want to. But if you're just doing 100 a month into a plan for 4 or 5 years and then bumping up to 500, that 4 or 5 years, even if the agent is structuring it properly, there's not going to be a lot of cash value available to you. Now, how this differs from like a Roth IRA or a traditional type of life insurance, traditional IRA, is there would be less cash value in the first 10 years, let's say, than what you've put in there, but you would have access to that money. Unlike most retirement accounts, unless you're taking a loan that you have to pay back with interest or just a withdrawal, penalties and taxes from the IRS, you really can't touch your money until 59 and a half in most retirement accounts. When it comes to the IUL or life insurance in general, if there's cash value available, you have access to that cash value. If you withdraw from it, you will pay taxes on that money. If you take it out as a loan, you will not pay taxes on that money, but that loan amount will go against the insurance when you pass away. And a lot of times I am structuring insurance to where we do what's called minimum death benefit, maximum cash value. So I'm decreasing the amount of insurance, therefore decreasing my paycheck as little as possible so that the client is then getting more return. Because the more the insurance is, the higher the cost for that insurance, the more your money goes towards the insurance, not towards the cash value. Does that make sense? So the more that the insurance decreases, the higher the cash value will go. Now, we also have what's called a MEC limit, MEC, modified endowment contract. We don't really want to go above that. You can go above that. Things then become taxable and a little bit more strict on what kind of policy you have. Generally, you're going to have a lot of room before you get to that, and that MEC policy is determined by how much the insurance amount is and what you're contributing. For example, if someone's doing $500 a month, that's $6,000 a year. There's probably a MEC limit of 14, 15, maybe even 20,000 a year. So there's still a big window of contributions that you can have to put towards that account. So really, hopefully all that makes sense. I'm going kind of rapid fire here. I'm going a little bit off script. I really don't even have a script. I'm just going from the heart and from the mind. Hopefully you get some good details out of this. Really what it comes down to when you're looking at insurance and IULs or Roth IRAs, individual retirement accounts, whatever it is, really pay attention to what your cash value is looking like. And, maybe do a little research into the guy that's trying to sell you. I'm the guy that's trying to sell you. That's what I do for a living. I'm an insurance agent, financial professional. But I am trained, and we specifically specialize in creating the plans that work. I know that my own accounts, I'm averaging 8 to 9% interest. 2021, I got 16% interest in my IULs. So I know that they work, but it has to be structured properly. And if it's not, it will burn you, just like it did Dave Ramsey way back when. And now he's completely against permanent insurance, which I can agree with him. If you get a bad agent, if you get a bad plan, it's going to burn you. You're going to lose money. But in lieu of all that, if something were to happen to you prematurely, there would still be an insurance amount that would go to the family. It may have cost you more than a term policy, but there's still benefits to the insurance side. But again, it needs to be structured right, and it needs to be done properly. That's what I like to do, specifically, like I mentioned earlier, for business owners, for small businesses and individuals, to really make sure that their life is covered if something happens and beyond. We don't want you running out of money. We want you to have enough money for the rest of your life. That's the focus. So make sure you got it structured properly. That's it for today.